technical challenges this morning, so sorry about the delay. So apparently Robbie Chrisman is under evacuation orders in Kuala. Do I have the name right, Rob?
Oh, nice.
I have Rob Chrisman on the phone. He's trying to get in.
Wait a minute, I can see you too.
Yeah, because you're on through a different link. So can you hear?
This should be. I can hear Rob.
I don't know if anybody can hear me.
Can you hear him, Kevin?
I can hear him, but hold his phone closer, your phone closer to the microphone, and then we'll hear him better.
I don't know where the microphone is.
Let me try.
Okay.
Yeah, that works. There you go.
There we go. We got it. Okay, don't move, Rob. Holy guacamole. All right, this is just, you know what? It's just another day in the office for all of us.
Another day in the office. So we've gone through hurricanes and earthquakes, and now we're just dealing with the floods and stuff. I lost power earlier today, and I thought I'd have to scramble, so I fortunately did not. Came back.
Okay, so thank you too. We have two people saying they can hear you, Rob. So we're in good shape. So welcome everyone to Mortgage Pros 411. I'm Audrey Boissonou, my co-host Kevin Casey, and we have the father of today's guest on. It is Rob Chrisman joining us because Robbie is in a place that hasn't had power or water in days and apparently is under some sort of evacuation order. But we thought he was going to be here and his technology is not working. So we are pivoting.
Have this backup guy that's kind of, I don't know if he's a good backup. I mean,
I know.
Honestly, does that tell you how good our show is that we have a backup of Rob Chrisman?
Well, thank God for Rob Chrisman. That's all I can say. And, I always tease Rob that he has to practice his smile in front of the mirror before he comes on. And so today, are you not going to get a video? You don't have a video, right, Rob?
I can't.
Okay. So just know he's smiling on the inside, right, Rob?
No, today he's smiling. He's smiling a lot. He's got a huge grin on his face.
Meine Güte.
I am smiling.
Okay, and now, hang on. You're going to love this. Robbie's calling. I'm adding him. Robbie Chrisman, you are on live on Mortgage Pros 411.
Oh my goodness. Well, I was just going to tell them I never got a calendar invite and I've had no electricity at my house for the last 8 days.
Yeah, so I sent the calendar invite twice. And so here we are. We're just pivoting. So Robbie, welcome. Rob, say hi to Robbie and then you can stay or leave. We're going to do this way. Ready?
Ready.
Okay.
Can I hang up?
It's up to you. Totally up to you.
You can hang out on the show and just we can have the four of you guys. That'd be great. Or the two.
Right.
Yeah.
All right. So let's get this thing going, shall we? So Robbie, welcome. We really appreciate you being here, even though you haven't had power in how long?
8 days.
8 days.
Oh my God.
Holy smokes. Okay. That is some dedication to show up this way anyway. So let's start with Robbie. Let's talk about you in the mortgage industry, because you are not just Rob Chrisman's son. You have a 15-year history in this big business, even though you're how old? 30. He's 30. So you started in the mortgage business working for RPM, doing office duties and drawing docs and all sorts of things while you're in high school, right?
Correct.
Okay. So then you go to college and you get a finance degree. And then tell us from there, what have you done? Because you stand on your own. You are a mortgage industry expert, even though you're only 30.
Talking about my entire career is founded on nepotism.
Okay.
You know that.
So while we appreciate the nepotism and what it has done for you, you have your own qualifications, and we want to hear about that. So go.
Well, my first job out of college was actually racing bicycles in Switzerland.
Oh, for God's sake. Okay. Well, so much for your credibility. Thanks for helping.
I know those dock drawing skills brought me, a lot of help in the Alps up there, breathing for oxygen.
Okay. So you learned to operate under difficult circumstances And then what happened?
I need you to write my resume. I love how you spin things here. This is fantastic.
Of course, I do my research, Robbie. I mean, this is not my first rodeo, okay? Speaking of which, he went to the University of Texas at Austin, right? So
Speaking of which, I think the professional bull riders circuit is happening in like the Houston rodeo is happening soon or something like that.
yeah, I don't care.
Anyways,
So
yeah,
then you worked at SoFi and you ran their lock desk, right?
I started at SoFi. It wasn't many. There weren't many people working there, and they didn't really have a mortgage division. I was kind of employee number 2 in the mortgage division, which gave me an opportunity to be a jack of all trades in a sense, from working with vendors to setting up contracts and updating product guidelines with underwriting and working with the credit committee to running the lock desk. I just have everything there, which was great. Warehouse lines would come in and they wanted to do due diligence. I'd meet with them, so it gave me a really good holistic view of the origination process. Which, if people were looking for advice on getting into the industry, then I would say it's best to understand all different parts of the mortgage origination process rather than being siloed into a specific role.
I would agree. I started in the business as a processor and actually worked for my mother's company. Just that's how I got in the business too. And so I always think I'm a better LO because I have a processing background. I understand how loans are put together. I knew, from a million different styles of being an LO, et cetera, what I wanted to take from and leave. And so I think it's brilliant that you have such a broad overview of the industry, before you decide, what, you're really a capital markets guy, right? Is that how you would characterize yourself?
I characterize myself as a capital markets guy. Yes, more so than other things, but not like my dad who ran secondary for a couple different companies.
Do you want me to call you a mortgage influencer?
Well, did anybody who appears on this show a mortgage influencer?
I would perhaps. I don't know.
Everybody on this show is a mortgage influencer.
I ignored your calls in the lead up to.
Okay, and I read in the Wall Street Journal you're going to be an uncle. What about that?
I am. Are you an only child, or do you have siblings?
There's 6 of us. Are you kidding?
Well, it's been a little weird having a younger sibling go through a major life event like that before me. It makes me think. Makes me wonder if I have my ducks in the correct order.
Really? You're thinking you should catch up and have babies? Good Lord. Okay. No one needs that pressure, Robbie. Let it go. Okay. I bet you'll be a
I
great.
just want to throw this little caveat in, Robbie. I don't think there's anybody in the mortgage industry that is not from a family member.
Okay, hang on. Both of you are talking at the same time. Kevin, let him speak. Hang on. Go say that again, Robbie.
How long until I can be a bad uncle and start ruining the kid's diet by giving it lollipops when it should be having applesauce and giving it Capri Sun and Kool-Aid instead of organic pressed juice?
Well, I just think you should remember that you are going to have children eventually, and whatever you do to your sister may be done to you. And so take that into consideration as you're planning your sabotage of your nieces and nephews potentially. So there you go. I just wanted to take a moment too, and because this is important, I don't think it can be said enough in the wake of the layoffs, et cetera, that are happening in the industry. You have a place on the Chrisman Commentary where you do job postings, right?
Yes.
So can you please tell people where they go to find those postings if they're looking for a job, or if they want to post a job for that matter?
You can go to lendernews.com. And employers can post listings for a nominal fee, and those interested in legal employment can view the job postings for free.
Okay, gotcha.
What's the website again?
Lendernews.com.
Lendernews.com.
Okay, so if you are looking for a job, if you know someone who's looking for a job or someone who needs to post a job, go to lendernews.com and there you go. Because again, I was just listening to a podcast by the NBA chair. Rob, you can help me. I can never say his last name correctly. Brooks Smith, thank you. Oh, Robbie, sorry. You can help me too. Anyway, he was saying that we are from peak to trough as far as the mortgage industry and jobs goes. We're probably halfway through the layoffs that we're going to need. And I thought that was interesting. He said that NBA was projecting a 25 to 30% drop in mortgage employment. And we're like halfway through that. With that being said, that's peak to trough, peak being the biggest volume years we've ever had in this industry in 2020 and 21. So again, some perspective is always in order from my perspective, which is let's go back before 2020 and look at employment and where are we compared to that. And that's a much more reasonable comparison, right?
Right.
Are you with us, Robbie?
I am. It's hard without video here.
It is.
Decipher who you're speaking to.
It is.
I'm so sorry and embarrassed about this.
Okay, so first of all, let me just say this kind of reminds me a little bit of in the beginning of the pandemic, we had the DRE commissioner on. He was new to the position and everybody had transitioned to being at home, right? So he was embarrassed that his dogs were barking and we're like, are you kidding me? Dogs barking? Blah. We can handle anything. So the fact that you are here today, despite the fact that you haven't had power for 8 days, I mean, hats off to you, Robbie, really.
And where is Robbie again?
You say, where am I?
Yes.
I'm on the California coast.
So is Kevin.
So am I.
He lost power twice today. So again, here we go. And I was off and on internet last week during a big storm 3 times. So just don't sweat it. All right, let's keep going. All right, so let's talk about, and this was one of the things I tried calling him and his phone wasn't working at the time. So do you have a favorite headline from 2022 that was just complete bupkis?
In the mortgage world? Or
yes.
anything?
No, not anything. Just let's keep it to mortgages. I have 2. I want to hear what yours might be.
Can I hear yours to help spur my train of thought?
Yeah, 100%. So first one is in transitory inflation. That was some bupkis, wasn't it? And then my second was foreclosures up 185%. And if you took a dive into that little number, then you found out that, okay, wait, please hold. There was a foreclosure moratorium the year before, and foreclosures are still next to nothing. We're at 40-year lows, even now, as far as delinquencies go. So, I mean, again, the idea that these headlines, we talk about this all the time. You cannot read a headline and think that is the news. You have to take a dive into the information and really understand what they're talking about. So, again, up 185% from zero. So now we're at like 0.3% on foreclosures, which is a really low number for the industry. So what do you got, Robbie?
I thought it was funny how people back in June were saying that was probably peak rates, and people should write it out. I think rates were in the mid 6s then, and then they got up over 7% in late October, and it's just funny considering how big of an influence the Fed was having on the MBS market, and even as they were shifting to not buying securities, then shifting away from reinvesting the proceeds. People thought that rates had reached the peak, and it's like, even still right now, I think rates have a lot more room to go up than they do to go down.
Really? Okay, we're not hearing much of that at all, because really the idea was the inflation peaked like November-ish. So we'll see, because we have CPI on Thursday. So we'll see if we're holding strong with these inflation numbers, but they've moderated to the point where it seems to be helping rates. So you don't think we're on a downward trajectory on rates? Not a straight trajectory, by the way, but
I look at the yield curve, and at some point the inversion will fix itself. But if we think the shortest point on the yield curve is the overnight Fed funds rate, and that still has projected 75 basis points of raises left in it based on what the Fed has telegraphed, and the Fed has also said they're committed to holding it there a higher point for longer than markets are predicting. There's 75 more basis points of upward movement at the short end of the yield curve. What's that mean for the longer end of the yield curve? And obviously, if things stay inverted, the 30-year treasury bond yield won't rise as much as 75 basis points, but it should still go up a little bit. I also think, the recession is very well priced into markets in a lot of ways right now.
Yes.
And if that does, with this latest jobs report that was very, very positive on Friday, if the Fed is able to engineer a softer landing than what is expected, and we don't go into a severe recession, there's no reason for rates to drop that drastically.
Okay, so first of all, there are no indications that the Fed is going to engineer a soft landing. From my perspective, I know they would like to. As a matter of fact, I think I've even heard them refer to it as sticking the landing.
This last jobs report showed, above consensus job growth at the same time as wage pressures were moderating.
Right, totally.
That's as good of a report as you could get.
It is, but the Fed doesn't seem to be acknowledging that was the messaging. And so there are still Fed members who are out there since then talking about how, they got to keep on driving. Like, they're not saying that. So again, they're not known for soft landings. They're known for overcorrections one way or the other. So, but it's good that you're optimistic.
Well, I'll throw you a bone here a little bit and say the effect of the Fed rate hikes are, takes time to trickle through the economy.
100%.
So what we're seeing right now, in terms of what the economy is doing, is still kind of as a result of before the Fed started this series of 4 consecutive 75 basis point hikes. The real restrictive monetary conditions haven't fully filtered through the economy, and it'll be interesting to see just how severe of an effect that has. The Fed, though, has made it clear they would much rather over tighten than under.
Oh yeah, yes, that messaging is loud and clear, 100%.
And they're saying that they're talking about raising another 50 to one more basis point and full basis point in the next few months. So it seems like the 50 basis point increase coming up into January is kind of built in, and it sounds like there's going to be another one right behind it. And then it's like, well, let's see how it goes from there. So maybe there's another quarter after that. I don't know.
Well, but also historically, and I haven't seen this number recently, but it was a while back. 50% of the time when the Fed would raise, the rates would go up. 50% of the time they'd go down. It's all the other factors that drive that. So it's not a direct path one way or another. And they're controlling the short term, and the long term doesn't always follow suit. So it'll be interesting to see how it ends up. Plus, we learned last year, all those projections that were made at the beginning of 2022 were, how should we put it?
Butkus, I believe.
Butkus. Is that the word today? That seems to be the word today, butkus. So, nobody saw 2022 coming. Nobody. There was no one who said, oh, rates will be 7 3/8 by, November. Nobody said that, right? So I think that we, as loan officers, you have to take what's going on right now and in the short term, bet more than the long term. Okay, this is what we are hoping for and expecting, but be ready for it to be something entirely different. You know what I mean?
Yeah.
Oh my gosh. Are you okay?
I'm okay. I'm on, 1 bar of LTE holding the phone at a specific angle to the satellites above, hoping that my voice can come through consistently.
God bless you. You're doing great. Sounds good so far.
Gods are taking care of you so far.
Again, MBA is forecasting a short and shallow recession in 2023 in the first half. With the shallow part, because that was the part I was like, wait, what? With the shallow part.
Can I interject, Audrey?
You may.
Short and shallow reminds me of a friend of mine's dating life in college. But that aside, Robbie knows how I feel. You know how I feel about people predicting the future and how.
Yep.
If you're going to put a number on it, don't put a date on it. If you're going to put a date on it, don't put a number on it. and short and shallow. You know, this is the longest awaited recession we've had in the history of the United States. I mean, you can't watch CNBC or Bloomberg or anything without them talking about, or without somebody coming on talking about a recession. And to Robbie's point, the employment numbers that came out Friday were fantastic. The economy continues to chug along well, and sure, we get hit by storms, you know, in the Midwest or out here in California, but overall, the wages are doing well, employment is doing well, personal income, consumption, retail sales, and you know, GDP. I mean, it's just not an recessionary economy. So,
right.
You know, you talk about the Fed not reacting to the number. Now you really got me going there, Audrey. Sitting there grinning. See you, but you can't see me.
Oh, I know you're smiling on the inside, Rob Chrisman.
That's right.
Yeah.
That's right.
Mm-hmm.
I think we're in a pretty good place right now, but I don't necessarily agree with Robbie thinking that rates might go higher rather than lower. I think we could easily be here leading up to Christmas 2023, looking at the same interest rates. And I think that the sooner that lenders and loan officers get used to these rates, the better.
Right. And it's our job to wrap our brain around them and stop being afraid of them, because again, yes, volume is down big time. Inventories are incredibly tight right now, but first time buyers a year ago were 26% of the market, and today they're 28% of the market. Do the math on that. You know, people are buying houses, and this year they think we'll end up a little over like $2.25 trillion in originations, and that will be a little under 2 trillion for this year, for 2023. So again, there's business out there. The people that I'm hearing that are busy, that have business, they're not fixated on these conventional 30-year fixed rates.
A lot of private money. They're
doing tough loans. They're doing I-10s. They're doing foreign nationals. They're doing DSCRs. They're doing investment properties. They're doing, well, I guess DSCR and investment properties are the same thing, but it's getting outside of that little box that a lot of people have lived in for a really long time because it was really easy, and doing something different, making different contacts, making different, becoming familiar with different loan programs, et cetera, and not being afraid of them. And also not letting the borrowers dictate the narrative on rates, because the rates, historically speaking, are not bad, especially now compared to November. So again, go back to your borrowers who a few months ago were saying, oh my God, rates are too high. Let them know they're lower now. How about now? Let's talk about the payments today versus then. And let's look at the fact that you probably don't have to bid $500,000 over asking. But, there's still business out there. And I don't know if I talked about this last week. I have a realtor who had a property going on the market. It was due to go on a little over $4 million. And they got a preemptive offer that they took that ended up being more than the asking price was going to be. So again, this idea that the high end is dead is not entirely true. I mean, again, you've got to have things priced correctly. It's got to be a property that is presenting well, so people don't walk in and go, holy crap, I don't know what to do with this. You know what I mean?
Yeah, I had one yesterday. $9 million price in San Francisco, preemptive offered.
Yeah. I mean, things are selling, and average days on the market across the country, 24 days. That's not a long, things aren't just sitting there on average. There are different markets, obviously, but still. So, and I just want to go back to Rob Chrisman's comment about recession, because if you remember, Kevin, he has never been on this recession train ever. So, and we've been talking about it since August of 22? Yeah. And so he's been very consistently correct so far. So we'll see how that goes.
Well, my things that I track.
Finds an acorn once in a while, as my dad used to say.
Say that one more time. All I heard was acorn.
Oh, even a blind squirrel finds an acorn once in a while. And I apologize for not being politically correct for all the blind squirrels that are on the call here.
They're offended and they are starting to huck things at you. So yeah, we got that going for us. Great. So Okay, so the question is being asked in the chat. So we're looking at 6 to 6.5% at Christmas 2023. Robbie?
If you're gonna put a number on, don't put a date on. If you're gonna put a date on, don't put a number on.
Okay. Okay. You know what? You're right. I will make a note of that. Okay, so it's interesting though, because this market is really different than a traditional, like, you know, again, we had 2 quarters of negative GDP last year and nobody called a recession. All right. And now, so
Audrey,
yeah.
Audrey, I mean, I would say the rates are the rates. And as you just said, there's still demand out there for housing. And if someone is able to qualify for a mortgage, you know, this isn't the subprime underwriting standards of the pre-financial crisis. They can qualify for a mortgage at a higher interest rate and then refinance in a couple of years as the economic cycle takes its course. They're going to be in a great position. You know,
right.
If the dream of home ownership is there, I wouldn't let a couple of years of high rates completely derail that.
Well, it's funny. I did a interview for a publication yesterday and they were, you know, asking like all these questions around rates. And I'm like, okay, is it a good time to buy a house? Why are we trying to time that with regard to, you know, oh, I've got to have the lowest rate and the lowest price all at the same time? I mean, the question really should be, do you need a place to live? Do you want to buy investment property? Does it cash flow? Like I have a client who is an investor who he had been waiting. It was too competitive out there. He didn't want, you know, so he didn't want to get in the fray on that. And now we are working on him buying another investment property. And I just looked at him and I said, it's not about the rates. It's about cash flow. Can we find something that cash flows and works in the, you know, and he agreed. So those are the conversations we have to have is keep it real in this fixation on, you know, the rates, the lowest rate, bragging about it at a dinner party. Oh my gosh, come on. You know, we have to get past it. And it's hard because it's kind of reflexive for a lot of LOs, right?
So Audrey, I have my little tracks I do on the economy all the time. You always give me a bad time about, of course, but they're both off the charts right now. Tower cranes in San Francisco are currently around 15, which, you know, that's huge comeback from the 2020 when they dropped down to almost nothing. I mean, usually it's over 10 is a good, strong economy. Over 20 is like booming. We're right in the middle. So that's a good one. The other one is whatchamacallit, container ships off the Bay Bridge. Normally the capacity is 15 ships. There were close to 20 the other day when I drove through. I'm like, holy moly, I've not seen that many even during COVID.
Okay, so I would like to ask the Chrisman men to chime in on your power crane data and how it relates to the economy and the strength or weaknesses therein. Go.
Wait, you cut out there. The what?
Tower.
You want us to comment on?
Tower cranes, and they're being a leading indicator in the economy and how well or not well it's going.
I would say that's probably a good indicator. You know, shipping numbers.
Mm-hmm.
There's all kinds of interesting economic measures that are out there that actually I think are very valid that tend to be glossed over or not even mentioned in the press. And I think when you talk to an economist, and I know you're buddies with good old Elliot Eisenberg or you know, my friend Tony or some of the other economists that are out there, all of them, they all have their interesting little nuanced economic measures that they use that they think are accurate predictors of what's going on or what's going to happen with the economy. I think that makes a lot of sense. You know, cranes are one of them. Ship traffic. You know, when you look at inventories of certain stores, if you look at, you know, lines out fancy restaurants, you know, that's one of my favorites.
Yeah,
like,
that is your
this
favorite.
restaurant is busy, or this airport parking lot, I had to park way out in the boonies because the airport parking lot was full. That's my little thing. But there's all kinds of, you know, power consumption, water consumption. help wanted indexes in the newspapers, et cetera, et cetera, et cetera. It just goes on and on. So yeah, cranes, building cranes. I know that China, when I talked to people who visited China some years ago, they said they counted like 38 building cranes in Shanghai or some like crazy number. And you think, okay, well that's going to happen. You know, people count car shipments. You know, counting. Go down Highway 5 or highway in the United States and see how many cars are being shipped. There's all kinds of things like that. So anyway.
Yeah, I have another one. It's out-of-state license plates.
I need to get back on.
I didn't hear the last thing you said.
Oh, I said we've gotten off the mortgage path here. We need to get back on the mortgage path.
Well, again, though, I think that people are looking for, first of all, you need content for whatever your video or outreach to the consumer is. So, and some ability to counteract some of these false headlines we're seeing out of even some of the major news channels. And so it's, and Kevin always thinks I'm giving him crap about the tower crane thing, but there is something to it. So it's interesting to look at. And I think it's funny that you always talk about, how many people are out at high-end restaurants, Rob, which would indicate you're always out at high-end restaurants, but that's a whole nother conversation, I guess. So, so Robbie, tell us your thoughts from a millennial perspective about, let's talk about getting into the industry and how that goes, for your age group right now. I mean, are people interested? Are you being recruited out of college? Like, what's that looking like for your compatriots?
And my thought has always been that there is a void. And you want to talk about leading indicators. Every conference I go to, I just see old people in suits. I don't see much youth, and I've been in this industry for over a decade now, a decade and a half, and not much has changed. Even 15 years ago was, oh, the youth is coming, the youth is coming. It's like Paul Revere, the youth is coming, and it hasn't necessarily materialized to the extent that I would have hoped. However, I do think that there is a incredible opportunity there as the older generation continues to retire. And you see it in various areas of the real estate cycle where appraisers, we need appraisers. There's not a lot of young appraisers coming in, not a lot of young inspectors coming in. There's definitely room out there for young people to get into the industry. And on a slightly qualitative level, it's a great industry in terms of you're helping people realize the dream of home ownership. And what's a better American dream than home ownership? And so for those that are out there, I don't think people think mortgage industry a lot when they're getting out of college. They think, oh, I'll work for an accounting firm or a finance firm or some FinTech company, and which is incredible considering how much of an impact the mortgage ecosystem has on the overall U.S. economy. I think there's a lot of opportunity out there. I don't know what necessarily spurs people to get off, young people to get off the sidelines and get into it. Maybe it's incumbent on mortgage companies going to college campuses and doing more active recruiting, things like that. And I know some companies that do actively recruit on college campuses, and they seem to love the outcome of those types of programs. My friends know I'm in the mortgage industry. My friends know I enjoy my life a lot, my career, and but none of them really ask how they can get into it. I'm confused at the disconnect.
Well, so Jill made the comment, average age of realtors has been about 54 to 57 years old for 20 years. It's the second career. And I think there's probably also something with we're all on commission. I mean, if you're lucky enough to get a job where you get paid a salary, great for you. But the rest of us are on commission, and a lot of young people, I think, are hesitant about risking everything and going into that. Would that be a valid point from your perspective?
You weren't complaining about commission in 2020 and 2021 when a lot of LOs were making really good money. Okay,
but you have to average it out. You know what I mean? Like,
it's scary. It takes a certain mindset to be an LO or a salesperson in general.
Yeah,
definitely. You kill. You got to get out there.
Yeah, exactly. All right. So
can I interject, even though I'm not a millennial?
Or on the panel officially, yeah, go ahead.
Put in his place. Geez, I need to regroup after that one.
I don't want you to cry though. I hate it when you cry. So go ahead. We love you.
All right. No, I think Robbie hit on something there. The commissions over 2020, 2021 were very, very good. And I every once in a while I get an email, and I think I may have written about the last one, where something like, Rob, in 2020 I made 700,000. In 2021 I made 900,000, and in 2022, I think I made like $250,000. I took a huge hit, and I'm sitting there thinking, oh, $250,000. Poor loan officer. Obviously, not all loan officers see those numbers. It does take a lot of work. There's no way I could be a loan officer. Being a loan officer is very, very difficult. I don't think people realize how difficult it is to sit there and deal with borrowers and the questions and the. You're not only dealing with psychology and behavioral economics, but on a big picture, you're dealing with global economics and company policy and agency investor guidelines. You're in effect running your own little business. And I would say that it takes a certain person to be able to do that. Not that somebody in their 20s and 30s can't handle it, but it is a tough job.
It is.
And coming out of college, I think I'll write code, or I think I'll become a pharmaceutical salesperson, or whatever it might be, tends to be an easier path than being a loan officer, because being a loan officer you need to know so many disciplines well to be good at it. And it's tough.
Yeah,
tough.
That's exactly what this is all about. I think that's probably what gives us, it's our perspective, Kevin's and my perspective as loan officers. Every question we tackle, every conversation we have comes from the perspective of a loan officer, and how do we navigate all of that? And it's difficult. And by the way, somebody just called me a badass in the chat. It makes me really happy. So I don't know what the hell I said that would prompt that, but thanks, Grant.
And there were a couple of stats as far as we've been kind of tracking, and that was first of all the renewals by loan officers. And when we first saw it, it was like a 20% drop off in renewals this year. But when we dug down into it, what it was is there was a couple of things that were happening. Yes, some loan officers were choosing now to retire. They hit it big for 2021, 22, and they're like, okay, this is not happening again, and I'm getting up there. I'm going to call it quits now. But more of it was loan officers that had gotten licensed in multiple states were letting some of those state licenses go, because they say, hey, I haven't closed a loan in Alabama and for the last 3 years, why am I keeping that Alabama license? And that was where we saw a lot of drop off. The other thing too, we were looking at the numbers of new loan officers getting into the business. That's dropped off by a third of the people taking the 20-hour course. But it's gone from, it's only off a third. That means that still 2/3 of people are still getting in there. There's hundreds of people in classes taking to become a loan officer in 2023. I mean, that's pretty impressive numbers.
Yeah. Yeah. And also, we won't have those final numbers from NMLS till around the beginning of March, it sounds like. So we'll keep you posted. We're just interested in tracking that, because there wasn't a huge increase in new LOs coming into the market, or the number of LOs in the market. There hasn't been the big humongous decrease that we were expecting. And so I find it interesting to watch, that's for sure.
Yeah. Now, the other one we watched on our side when we send our emails is, we see all the loan officers who are no longer at the email address anymore. But that doesn't mean they've gotten out of the business. That just means they've changed emails and went from one company to another company. So if you moved, let us know your new email.
Yeah, it's hard to keep up with all that. I'm sure you guys know from your podcast and commentary too, that keeping up with the people moving around and changing emails, but not remembering to remind everyone is not easy. Someone made the comment, did you consider the LO switching to brokers from lenders? And, there's a lot of back and forth on all that at the moment, as usual. That's pretty typical, I think. So, there is tons of movement right now, both at the wholesale and at the retail level. So you've got AEs who are moving all over the place. I mean, it's interesting out there, that's for sure. So let's talk about that for a second, guys, because we are seeing some companies really grow right now. They're adding loan officers, they're adding states, they're adding to their operation, and others are going out of business. What do you think the difference is, and how do we watch who we're sending loans to, and will they be there when we want to fund? Rob, okay, whichever of you may have a comment on that.
That was such a convoluted question, Audrey. I thought it was going to be directed at Robbie. Sum it up in one sentence. What's the question?
Okay, just focus. Are you off the spin? Are you out of the spin class now? Or are you still trying to do two things at one time? Because it's not going great. Okay, some companies are growing, some are going out of business. What do you think the difference is right now? We have the same market. So why are some places doing great and some are not?
So I don't know exactly who's doing great. The industry is, as an industry, we're dealing with higher rates, we're dealing with lower margins, lower volume, lower revenue. End of story. The days of 2020 and 2021 are over with. Arguably, they'll be the best 2 years that mortgage bankers have ever seen. That said, some companies were quicker to make cuts as 2022 progressed. They had slightly different business models than other companies. There are higher margin products that some companies were quicker to switch to. You had a environment where, if you had put some technology in place and were able to leverage existing personnel, some of those companies did better. But yes, some companies did make money on a global scale. When you talk about companies that made money, typically those mortgage banks own servicing, and those servicing rights certainly helped the balance sheet because the value of the servicing went up as rates went up, because the chance of those loans prepaying went down. But also the servicing income. If it costs you $1 a month to service a loan because it's automated and you're making $10 a month per loan on the income, then it's a nice cash flow, and you can leverage that up. So the larger companies that held on to their servicing have done well. I frankly saw a lot of smaller companies selling servicing to larger companies in order to get cash flow and income. And so there was some of that, but that only lasts so long. And that's why you run out of service stuff, and you run out of runway, as the popular saying is. So it's not like there are companies out there saying, wow, these are the best of times. There were different ways to handle 2022, and I think the sooner you bit the bullet, the better off you will.
Well, I think you're kind of missing the elephant in the room, and servicing was obviously a crucial piece, but how about having a plan? How about having specific milestones for scaling your company in one direction or another? How about having things written out beforehand and being proactive rather than reactive? People that have been in this industry a long time know it's an incredibly cyclical industry. It wasn't going through a boom cycle for forever, and to not have a plan in place for what your company was going to do as that boom cycle wound down, especially when the Fed clearly was telegraphing, or clearly was attempting to telegraph their moves and what they were doing in the mortgage-backed security market. It's kind of lack of due diligence.
Okay, so in everyone's defense, first of all, I feel like the Fed was projecting one narrative and then had to shift gears. So I don't think that I think a lot of people reacted this year because nobody saw the rates going to 7 3/8. I don't think that was on anyone's radar that I heard of. Did you hear of anyone who thought rates would ever get to 7 3/8 last year? Because we were hearing the opposite from some people for the longest time. And so, you can have a plan, but I think the most important component is being able to pivot when things start to change. And that's, I think it was slow to pivot was an issue. And, there's a company out there that has $1 billion in loans they can't sell right now. And and so I find it interesting because they didn't pivot. They weren't able to sell their loans because they weren't pricing to where the market wanted them to be. And so it's really being able to have your eyes wide open, but also be able to acknowledge, okay, we need to adjust, even if it's a few degrees to the right or left or whatever, and not stay the course for too long. I think that's what took some places out.
So, and also those, I think it depends on your size. Like I was talking to a mortgage company down in Southern California, and the CEO was telling me how that they actually are planning on growing through all this because we don't need to produce more loans. We just need to acquire more loan officers. And just by acquiring more loan officers into our system that will start sending us loans, that's how we grow in this market. And when the rates flip, then we'll be just fine. And then you get the large companies, they seem to be doing okay, but they can't get more loan officers. That's not going to, they can only try to grab more market share. So I think that's where they hit the ceiling, and they just can't break that. And so a lot of companies who are competing against the big guys, they just can't get any more loan officers, and they can't get any more market share, and then that's where they start running into trouble.
Then you have other companies who are dumping loan officers, other companies there's no consistent answer that to the magic, there doesn't seem to be any magic formula for success, right? But be ready to pivot. That's kind of the
honestly, that is, I was having this conversation with an AE right before the call, and we were talking about that. It's where can you pivot the fastest at is where you want to be right now in this market.
Yes.
I'm going to stick to my guns though, Audrey, and say if the need is there to pivot, you should know exactly how you're going to pivot.
Okay, that's fair. Yep. Okay. So have a plan for either way.
Well, all right. The old codger needs to chime in here. So the saying that I use is an old football saying or basketball saying, which is keep your knees bent. And
yes,
another old tried and true saying is no battle plan survives the first shot. So, and along those lines, Mike Tyson has kind of claimed it as his own, everybody has a plan until the first punch is thrown. And so the ability, to Robbie's point, it is important to have a plan. And I could have mentioned that, but the ability for a management team to be able to adapt that plan or change that plan, I think is very, very, very important because, you can't base your business model on somebody's prediction of interest rates.
Right.
It just doesn't work. And so you got product, price, and service. And the price is the price. Well, what kind of products are you offering, and what kind of service do you want to offer? And what kind of service do you have a reputation for offering? And I think that is very, very important. It's good to have a plan. It's good to say, okay, we're going to roll out a constructed footprint, we're going to do extended locks, and we're going to do float downs, and we're going to do this and do that. But the ability to adapt your plan to a changing environment, I think, is very important. Just ask a brontosaurus how that worked out when you didn't have the ability to adapt. I threw that in there, a little dinosaur.
Yeah, thank you. There's nothing like a dinosaur reference.
We lost the blind squirrels. Hopefully we don't lose the brontosauri.
Oh my goodness. Okay, well, so from one dinosaur to another, thanks for that. So somebody had made the comment in the chat that for all the folks who were projecting 4% interest rates for 2022, they were taking the Fed comments at face value and the transitory inflation at face value, and that's how everyone got it wrong in terms of ending up at 7 1/4, 7 3/8, whatever that top rate ended up being. But it was, again, I think that we need to stay focused on, all right, what's in front of us, not try to project too far out into the future, because again, you can have Russia invade Ukraine and everything changes overnight, or you can have a pandemic hit and everyone goes into lockdown. You never know really what's coming anymore. And so just stay focused on closing loans, make sure that refis are not the only thing you're doing, because a lot of those shops are gone right now. And really nurture referral partners, find new ones, find new ways of doing business, different products that you're focused on. Because again, those, from what I'm seeing and hearing from my conversations with different AEs and different heads of companies around the country, is the people who aren't afraid to do the different kinds of harder loans, they're the ones who are doing all right. I mean, not doing great. No one's doing great. I used that word earlier, and Rob corrected me, and rightly so. It's not like anything was great, but some people are still, closing a considerable amount of business. So I just want to take a brief moment and mention a couple of things. So first thing is, just remember, we have a YouTube channel now. We have a website, www.mortgagepros411.com. All of our videos are being posted onto the website, and they will link to our YouTube page. I also want to mention that Jason Bellevue and his son, Ben Bellevue, have been the people who have been doing our YouTube channel, which has been an absolute godsend. I mean, they're really great. And people who are signing up to subscribe to that channel are getting notified, and then they're able to watch whatever show it is, as soon as they get the notification. So with that, a big thank you to Jason and Ben for all of their help on that. It's just been amazing. And then I want to talk for a moment about your commentary, and Rob, in your podcast, Robbie. So I'll start with Rob's, because if you don't know about Rob Chrisman's Chrisman Commentary, you should. It's very easy to subscribe to. You should be reading it. It has an unbelievable amount of information that is created for 6 days a week, which I don't even know how you do that, frankly. So Rob, just briefly tell them how to sign up for that commentary, and then we'll get to you, Robbie.
www.robchrisman.com.
Oh my God, look at that.
That's
So
simple.
easy. All right, Robbie Chrisman. So again, I hope we have established that you are a mortgage industry expert in your own right today. And how do people listen to your podcast that you do?
It's called the Chrisman Commentary Daily Mortgage News Podcast. But if you search Daily Mortgage News on any platform you get your podcast from, it should pop right up.
Perfect. That sounds great. So, and you do all sorts of interviews, and you're talking to different people. And so
yeah, maybe I could have you on it at one point, and then you could show up 15 minutes late and act like I didn't send a calendar invite.
That'd be great. Yeah. I'll do my best to make you look really crappy as much as I can. So we got that. So I'll look forward to that invitation. Thanks, Robbie.
You got it.
Oh my gosh. So anything as we wrap up the hour, anything that is top of mind for anyone that they would like to share with our listeners?
There's a mortgage conference coming up in Florida.
Not everyone all at once. Good Lord.
Yeah.
All right.
I picked one college football game all year, and that's last night. It was such a blowout. I turned it off for the first half.
All right. All right. Well, college football aside, Powell's is speaking today. Tomorrow we have a 10-year note auction. Thursday CPI. They're hoping for it to drop from 6% to 5.7%, but that's mostly built into the market. So just, be on the lookout, guys. As always, you have a lot more to lose than to gain if you're playing with the rates and floating too much. Next week, we have Bill Lohman joining us. He is always really interesting and entertaining. He is a great guy. So
Isn't he your boss?
God, is he? Jesus, Rob, I don't know. I guess it's so, yeah, that's a whole nother conversation. So anyway, so join us next Tuesday at, pardon me?
I didn't mean to touch on a sore
No,
subject.
it's funny because first of all, as LOs, I mean, do we even think we have bosses? Not really. I mean, so it's like herding cats with us. And then, he's a really good friend of mine. And so, yeah, anyway, yes. So we will have Bill Loman joining us. I can't wait. And you guys are great. And Robbie, I know you are going through, I don't know how you're staying somewhere where you haven't had power for 8 days, but thank you for jumping on here regardless. I so appreciate it. Rob, thank you so much for being, I mean, I can't even tell you how much I love you. And so thanks for backing us up today, not leaving us high and dry, because nothing's dry right now.
Yeah,
And
keep
then
safe out there.
yeah, it's crazy out there. That is for sure. We always have some extreme or the other. I'm headed to Florida tomorrow. We're headed to Florida tomorrow for the NAM Focus conference in Orlando. So we'll see what interesting little nuggets we pick up there. And we'll bring them back to you next Tuesday at 11 a.m. Pacific time. We'll look forward to seeing you then. Thank you everyone so much for being here. Bye.
Thank you, guys.
Thank you.
Audrey?